Hello everyone, Assalamu alaikum. Welcome back to the channel. In today's lecture, we are going to explore one of the most important parts of chapter 7, the balance sheets of commercial banks and central banks. This is from section 7.3.2 of our money and banking chapter, and by the end of this video, you will clearly understand how banks record their assets and liabilities, how money flows between commercial banks and the central bank, and why this system is so crucial for the economy. Let's start simple. Let's start by understanding the balance sheet. Now, what is a balance sheet? In banking, a balance sheet details assets and liabilities. A balance sheet is a financial statement that shows assets on one side and liabilities on the others. Assets are what the bank owns, or you can say what the bank owns or what earns them income. Liabilities on the other side, liabilities are what the bank owes to others. In banking, these two always balance out. That means total assets is equal to total liabilities. Now, if we apply this to commercial banks, that means CoB, and the central bank, and that means CB, the story becomes fascinating. Let's break it down. First, let's look at a commercial bank's balance sheet, or CoB. We're going to address commercial bank as CoB from now on. On the asset side, we find loans. Loans are the most important earning asset for a bank. When banks lend money to individuals or firms, that loan is an asset for the bank. Deposits with CB. CB stands for central bank, so we are going to address central bank as CB from now on. Deposit with CB, that means required reserves or balances kept for settlement purposes. T-bills or treasury bills. Short-term government securities the bank can invest in. That's what T-bills are. And then cash involved. Physical currency held by the bank. Then other assets. There are other assets like securities, buildings, equipments, etc. We are not going to talk about those. Then let's come to this side, liabilities. In this side, customer deposits. These three, the CA deposits, SA deposits, time deposits, these are customer deposits. Customer deposits are the largest liability for CoB. Let's start with CA deposits. CA stands for current account, that they are highly liquid, usually no interest. Savings account, that means SA stands for savings account. These give us small interest, widely used by households. Then time deposits, or TD, you can say, fixed deposits with maturity dates. Then other liabilities like equity, net worth, obligations, etc. There's an important point. A deposit is both an asset and a liability. The deposit is an asset of customer and liability of commercial bank. And loans are the asset of bank and liability of customer. Now, let's talk about balance sheet of central bank. The central bank is the bank of the government and the bank of commercial banks. Central bank is the bank of the government and also the bank of commercial bank. Basically, it's the bank of the banks. On the asset side, we can see T-bills and bonds. Then loans to commercial banks, foreign assets or FA, gold reserve, and SDR. Foreign assets include foreign currency reserves, IMF assets like SDR, you can see. SDR stands for special drawing rights. The loans to commercial banks are for liquidity support. Government security, T-bills and bonds are the part of government securities. The bonds are long term, obviously. And in this side, in the liability side, we can see currency outside bank. The notes and coins in circulation, basically. That means the money we see are the liabilities of this central bank. Then also deposits of commercial banks. These are the reserves that commercial banks keep with the central bank, and others like net worth, equity. In short, the central bank's liabilities are literally the money supply we use in daily life. Let's get to know some key concepts of foreign assets. Foreign assets include foreign exchange reserve. So foreign exchange reserve is basically export earning minus import payment is equal to net exchange. Foreign assets also include Remittance. In US dollars, remittance is basically the asset of central bank, and in BTT, that's basically currency outside bank. Now, let's know the government finance and central bank's role. So basically, if government expenditure is greater than government income, that means GE is greater than GI, it's a deficit. And for deficit financing, central banks play a great role. As you can see, CB's role here. CB finances deficits by issuing T-bills, printing money, and lending to the government. That means central bank finances this deficit. The GE and GI are the part of the government's current account, which is a liability of CB. Let's talk about money supply and high powered money. That's an important concept. So money supply. Money supply, or M, is basically our C, that means the currency outside bank. That's our deposit and time deposit. M1 is basically narrow money, as you can it's basically narrow money, which includes C plus DT. And M2 is basically broad money, which includes all the three. And then the high powered money is basically is a liability of the central bank. Why? Because every note says it's guaranteed by the central bank governor's signature. The base money is then multiplied by the banking system into a larger money supply through lending and deposits. The money we use is basically a combined liability of CB and CoB. And M is also a liability of commercial banks. Now let's talk about reserve. What's reserve basically? Reserve is equal to ER and RR. ER is basically excess reserve and RR is required reserve. Now, commercial banks must keep a portion of deposits as required reserve. For an example, if the reserve ratio is 10% and a bank has 1000 taka in deposits, it must keep 100 taka as reserves with the central bank. Reserves are divided into two parts. Basically, as we said earlier, ER, that means excess reserve, and RR, required reserve. Excess reserve is basically any reserves above the required minimum, and RR, or required reserve, is basically fixed by the central bank as a policy tool. Exchange reserve, there are two types: fixed ER, that's set by CB, and flexible ER, the rate changes with market demand supply. Required reserve is what we talked about earlier, amount of cash COBs deposit in central bank, or you can say some percentage of DD and TD. Let's talk about liquidity crisis and liquidity management. Liquidity crisis. It's basically the lack of cash involved, and it causes because of deposit of the commercial bank. And liquidity management, on the other hand, is the management of liquidity crisis. The call money market comes to help in liquidity management. Now, what's the call money market? The call money market is basically when one commercial bank gives a check to another commercial bank, the central bank transfers money. The commercial bank 1 then asks commercial bank 3 for money to retain the fixed required reserve. This interbank borrowing is basically the call money market. So to wrap up, the commercial bank balance sheet shows loans and securities as assets and deposits as liabilities. The central bank balance sheet shows government bonds, foreign assets, and gold as assets, and currency in circulation and bank deposits as liabilities. Together, these balance sheets explain how money is created, circulated, and managed. Key concepts include high-powered money, required reserves, excess reserves, and liquidity management through the call money market. Understanding these balance sheets helps us see the backbone of the entire financial system. Thanks for watching. If you found this helpful, don't forget to like and subscribe. In the next video, we'll dive into 7.3.3, the creation of money, where we'll see how banks actually multiply deposits and expand the money supply. Stay tuned.